The jobless claims is a leading indicator. And so that number spiked up. I'm not going to get in the moment, and say, oh, labor's breaking. It's softening. It's been softening. It's been softening all year, especially since the July jobs report, expanding our money supply because the Fed has been restricted. I'm going to explain that. Credit card loans, car loans, those are short-term borrowing rates, and they are low right now. Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop. Hey, it's KP coming to you live from Corona, California. It's about 9:30 West Coast time, midway through December. It is the 15th, and we are coming up on the end of the year. A lot to talk about. Not going to be as long a video as my last couple ones because, I don't want to beat the Fed meeting to death. We already did that last week. But we're also coming up on the winter solstice, which is the shortest, coldest day of the year. And then every day after that gets longer, which means there's a brighter day in 26. So if you're not feeling it in 25, that's okay. It's not everybody's year. So, not to be confused with Trollstice, for those that have kids that have seen the movie Trolls. Okay, so we have our PRMG Cares holiday fundraiser. And for those that are new to this little podcast, Caleb Malice is a very talented young man, the son of one of the four partners here at PRMG, Gary Malice, who runs strategy and capital markets. And his son is incredible. Like, his art is amazing. And so we have a great fan following. And he puts out some pieces that he creates. He does individual new pieces that are originals, and you can bid on them. And I know his dad is lurking, waiting for me to tell him when this post is here and put the link down. He's a proud papa. He's got two great kids, good family. And Caleb's been on Law & Order, SVU, Doc, even most famously on an HBO miniseries, Plot Against America, with Zoe Kazan and John Turturro and Winona Ryder. Great kid. And Canva was super cool. Earlier this year, they sent me to an American Film Institute Lifetime Achievement Award, the 50th one, for Francis Ford Coppola. And I took Caleb, and we had a blast. So anyway, check it out. This money goes to our 501c3. We have a charity, and it does benefit PRMG employees. This fundraiser is for $10,000 total that we're trying to raise. We have teammates here and family members here that their immediate family gets sick, they go through hardships, and this money goes directly to them. And so we do other things throughout the year, but this is a cool fundraiser that you get to participate, and you get something very unique and cool. So check out the link below. And I think you have just under 4 days. So I believe it expires kind of earlier in the day on Friday. So I guess maybe 5 p.m. West Coast time Friday, but there will be a timer on there. So check it out. Okay, so let's talk about labor and inflation, the Fed's dual mandate, which I've been saying for years that there's actually a tri-mandate. It's actually in the Federal Reserve Act. It says they have to have long-term stability of rates because they are the Treasury sales organization of the country and that's what seems like the world. Although Bank of Japan and Bank of England are speaking this week, which is super important for the flow of money. But let's go back. Bill Bodnar pointed out on a post the other day, and I was like, thank you. I've been saying tri-mandate for years, and it's validated. When Bill says it, you know it's good, from Tabrasa over there. So they're looking at labor. They were not as hawkish as people thought, somewhat dovish. I wouldn't say overly dovish, but they are concerned about labor. And so what kind of labor data did we get since my last report? The weekly jobless claims is a leading indicator. Think of it like locks. When we look at our locked pipeline, which our locks are holding steady, by the way, versus last month. It's great to see. I'm sure everyone else's is. Because refinance business is up. Regardless of any doom and gloom stuff that you've read anywhere out there, this year when the numbers come out, I can't wait to talk about it in January, refinance business was massive this year because people from 22 until now were paying higher rates for larger loans with more taxes and more insurance. So even a 50 basis point reduction in rate is a in the money net tangible benefit. So I digress on that. But the jobless claims is a leading indicator. And so that number spiked up. I'm not going to get in the moment, and say, oh, labor's breaking. It's softening. It's been softening. It's been softening all year, especially since the July jobs report, which we get a jobs report tomorrow, which I'll get to in a second. Since that jobs report, rates have been coming down. They've been highly attractive. And I don't know what people are comparing it to when they think this is a bad refinance. Like, are you comparing it to COVID? Who cares? Like, it's going to take a pandemic and zero Fed interest rate policy, ZIRP, as they call it, which we don't want and is likely not to happen. So anyway, continuing claims has been, like this high number. And according to our good friends over at MBS Highway, I could pull up a quick little chart. That number has been, for jobless claims, has been somewhat high. But it came down last week, and it came down just a little bit. And they brought up a very interesting point because people are falling out of the labor force on that statistic. Why? Because if you go 26 weeks with jobless claims benefits, then you fall off. That's it. That's all you get. You get 26. Well, there's a lot of people hurting, okay, that are unable to find work. And so this employment report tomorrow, I don't know that it'll necessarily validate it because it's the November report. Remember, every jobs report, which they call the employment situation, the employment sitch, also known as the Bureau of Labor Statistics, non-farm payrolls, jobs report, whatever you want to call it. Usually the first Friday of the month for the prior month. That I always say November because it's really the data being collected the second half of October and the first half of November, and then they compile it and they put it together. So there's two parts. There's the establishment survey and the household survey. So we're going to get both for November. But we're also getting the establishment survey for October. So we're getting half, okay, just one, okay, of the October report. We get a lot of data tomorrow. Now, Q4 traditionally over decades, I've been watching this data, is actually strong for job growth because you get a lot of seasonal hires. People are out spending. Our economy is 70%, GDP is 70% consumer spending. And this is the time of the year when we spend. Therefore, a lot of these places, need to hire. And so traditionally Q4 is a big hiring quarter for our country. So I wouldn't be shocked if the 50,000 or so job estimate for this November report comes in higher or hot. And if you remember the last couple of years, you get like the December report, which is in January, and then first week of February, you get the January report, which is really the second half of December, seasonal stuff before Christmas, and then all the New Year stuff. They've always kind of come in hot, which has then been killing all the bond market rallies. So if you've watched the 10-year Treasury yield, it's been bouncing around this level at 420, the Elon line, or as Bill Bodnar likes to call the Snoop Doggy Dog, the Snoop line, for other reasons, no judgment. But that technical level has been hitting up against, and we saw rates improve after the Fed meeting for the first time in many, many meetings. But then the next couple of days, 10-year Treasury started to drift up, and so it seems like with inflation kind of pushing up and jobs not weakening enough that if you get a positive jobs report, that you could see the 10-year Treasury pierce above that. And then, of course, that would kill our January and February, fundings potentially if rates go high. Seasonally slow time of the year for people to buy houses. Certainly, existing homeowners don't want to have strangers in their house during the holidays, so they delist. And of course, a lot of existing homeowners have been putting out crazy prices because that's what they hear, even though they're up big time. So, we may see the same thing happen again, but we may not. Right. And what's interesting about the unemployment rate, which is really what the Fed puts down there on their dot plot, which we saw last week, the summary of economic projections, they really watch the unemployment rate. And there's been a counterbalance to that, with immigration being basically zero this entire year. There's not as many workers coming into our country. And so, that's an offset to absorption for what jobs are out there. And we know there's, typically there's been less jobs out there, although the job opening a labor turnover report showed a higher amount than expected of job openings. So we're kind of in this weird period. And each of the last 2 years, or, this year and last year, the Fed cut from September through September through December, and then they paused in the first part of the year, partly because this data was kind of going up. Also, inflation was going up in some of those times. So we'll see if there's a repeat. But We also get inflation data, and CPI comes out on Thursday, and that is the Consumer Price Index. So, the shelter component in CPI has been coming down, and so it could come down this Thursday. So jobs could come in hot or as expected, not really move the market, not be weak enough to bring rates down, and then by Thursday, erase it all. Now, what was interesting in the Fed meeting last week is that Chair Powell said something that I put on my video last week. He said that we think the monthly jobs reports are overstated by 60,000 jobs a month. How does he know that? Where does that data come from? What's he referring to? They've never said that. Why is he saying it now? Well, on Friday is a QCEW. So that's the quarterly census of employment and wages. Remember that report a year ago that whacked 880,000 jobs out of nowhere? Like, hey, remember all these jobs reports, like the 1.5 that we're getting tomorrow? Just kidding. They were all overstated for this little time period right here from March to, April 1st of 24 through March of 25. They were all overstated by 880,000 jobs. Now, I apologize for not looking up the time period. I'm guessing maybe it's, April 1st of this year for a quarter, I think. So that's my best guess. I didn't actually look it up, so I apologize for that. But if that has revisions, and that's where Chair Powell was, what he was alluding to, it doesn't really move the GDP or the unemployment rate. There's so many factors that go into it. But again, it would be a sign that jobs are not as strong as we thought. And now the bond market may take that into consideration. So big, heavy data week, and it's on both labor and inflation. So get ready for some wild moves potentially. But the 10-year Treasury has been between 4.20 and 4% for quite some time. The spread between the 30-year fixed rate and the 10-year Treasury yield has been coming down, which has been, rates are great. Rates are in a good spot. There's just not a lot of buyers right now. So, on to 26. Some other data that's coming out. We get retail sales tomorrow, which is a snapshot of looking at the consumer. Are they buying stuff? Housing starts. It's obviously important. We got trade deficit last week, which was lower than expected, $52.8 billion versus $62 billion. So we're exporting more than we thought. That's a good thing, especially for our economy. And then, of course, after CPI on Thursday, the existing home sales comes out on Friday, in addition to the QCEW. So earnings season for Q3 is almost over. There's two notable reports coming out that relate to our industry, Lennar and KB Homes. Report earnings, always good to show. And so let me leave you with a outlook on 2026 about the stock market. I am not a financial advisor. I am not responsible for your losses, only your profits. One of the things I subscribe to is fund strats. Have you ever seen Tom Lee on CNBC? I like to see his clips. And maybe it's an echo chamber for me because I'm always positive and bullish, but so are businesses. Like, they want to make money and earn money and grow. And so, they're bullish, right? And so he has a technical strategist named Mark Newton who did an hour-long session today, and I was listening to it in the background. I read his stuff while I was working and doing other stuff. So I pulled out two nuggets from the bullet points, which I thought were interesting. These are predictions and a stylized way that they think 2026 will go. They do think the Santa Claus rally is intact to end this year. Seems like it to me, because you're seeing a lot of the biggest winners this year, the Mag 7, right? Those big tech companies, the hyperscalers, right? Google, which is crushing it. And of course, you've got Apple and Meta, which is kind of down, and Microsoft kind of down, and Amazon is kind of down. Tesla's crushing it right now, all of a sudden out of nowhere. And I believe Netflix is in that, excuse me, not Netflix. Which one did I not say? I always do this every single time I get up here and try to remember all 7, but you know what it is. Anyway, when you see them kind of come down in this like kind of flush out move like we saw October 20th and then this month and this week, seems to me like a setup for institutional traders to kind of sell and then get it to a low point to be able to rush in with money and catch up to show on December 31st to their wealth management clients that, like, hey, look, I bought you this stuff that's winning, so you won, right? So that's kind of a catch-up trade. It's kind of a mechanic. There's mean reversion. So Santa Claus rally could be intact. And then something likely will start to hurt the market in Q1. It gets a little choppy. And some of the things that he said today that might make the market choppy even see as much as a 10 to 20% S&P 500 correction are things like, the fear and the uncertainty of once it's named, whoever the Fed chair replacement's going to be. Maybe that gets announced in January. One of the two Kevins, Kevin Haspett or Kevin Walsh, Kevin Walsh, one of the two Kevins. He is, dovish, and the independence of the Fed, someone that's on Trump's administration currently to influence that, could strike a lot of fear in people who are inherently bearish, or half the country that don't like this administration, who've largely not participated in this amazing bull stock market run. It might cause them to sell off again. We got a Supreme Court ruling on tariffs. That could hurt things. A lot of revenue to pay off our debt, but the Supreme Court says that goes away. That could also cause a sell-off. So we'll watch those things and get back to you with the video later this week. Cheers. Hey, it's KP coming to you live from Corona, California. It's about 7:30 here on the West Coast, and trying to get out of here. Happy Hanukkah. Today's the 5th day for those that celebrate, and just several more days to go. What a great way to roll into a weekend. And then, of course, next week is Christmas for those of us who celebrate. And then for everybody, it's a new year, but also the winter solstice. And so, we've got a short-term and medium-term pretty big days when it comes to like the flow of money and how interest rates and everything will be impacted. And of course, the days are going to be the shortest possible in about a week. And then there'll be more light every day going forward. So things will be better in 26, right? So here's what's happening tomorrow. Of course, I'm going to talk about the jobs report and the inflation report and how interest rates have actually been coming down and improving. We've noticed that in our lock volume today was a nice little uptick, but not as much as you might think for these, remember, bad news for the economy is good news for mortgage rates. So just remember that rule. A recession, which not going to start all that talk quite yet, although a lot of signs point to like it's becoming more of a possibility, but recessions are actually really good for our business. Rates come down to reflate the economy. Then you get loan activity going, you get some purchase money going, and then people start to feel a little bit, more wealthy, and then, kind of drags the economy out of it. The economy is pretty, important for consumer spending, of course, 70% of the economy in GDP. But then, of course, if you can lock in a lower rate and fix your house debt and debt service, you have more money to spend. So what's happening tomorrow on Friday? So the QCEW, which is the quarterly census of employment and wages, it is basically a reset. So this is a statistic that it won't be like up to date. It'll basically be from April of this year through like a certain part. So let's say like a quarter, like 3 months. I don't know the exact dates, didn't look it up, but I know the report's coming out tomorrow. So, all these jobs reports like we saw a couple days ago, the first jobs report since the government shut down, these are estimates based on surveys. Okay. And then in those surveys, they kind of do some modeling, right? So on the establishment survey, which is, businesses, how is job hiring going? What's going on with you? They also kind of model in this thing called the birth-death ratio, not having anything to do with demographics, but are small businesses opening or closing, a birth or a death? And the good folks at MBS Highway, they put out like a really good, breakdown of all the numbers. It's like, when people talk about inflation and jobs, like I feel like they don't really dig in, right? And so I've tried to be really level-headed and try to explain some of this to you. But 413,000 jobs were created in the month of October because of new businesses opening up. Does that seem right? Does it even feel right? So, sometimes just trust your gut, right? Like the labor market isn't the best right now, in our country. And so, that's kind of overstated. And Chair Powell said he thinks that jobs are overstated by 60,000 jobs a month. And what is one of the things that they can reconcile? Well, they may be looking at that birth-death modeling, saying, it's kind of like gimmicky. But when the QCEW comes out on Friday, all the states are reporting back their payroll data. We're a California company. We tell the state of California, here's how many people we hire and fire every month. It gets reconciled, goes back, and then the prior jobs reports that we get the first Friday of every month, they get revised. And they've been getting revised down for like over a year and a half, like massive revisions. So the numbers that have been coming out in these job reports, course not during the shutdown, have been trending lower. So what's going to happen when the QCEW comes out tomorrow? So jobs are obviously softening. Now, the headline unemployment number was 4.6%. It was 4.56, so you round it up. But it was still up, and the trend is up for more unemployment, and that's not good. And then there's this U6 report, which is kind of the overarching, hey, everybody in the workforce, are you part-time, trying to get full-time? Did you get discouraged and stop trying to find a job? There's some of these metrics that don't get like even covered in the monthly jobs reports. So they're trying to encapsulate the entire labor force in that U6 report. We're at 8.7% unemployment rate. That's not good. So labor is weakening, and we know that that gives more clearance for more Fed rate cuts. Don't fight the Fed if the Fed continues to cut the rates, because labor and the economy is weakening. That will ultimately, in the long term, be good for mortgage interest rates, because they're going to have to cut the rates to stimulate the economy. But you don't want to stimulate the economy if you're going to cause inflation. So the CPI came out, and the CPI was low. And it was what, 2.7, 2.6 between the headline and the core? Now, I get it that people are skeptical of those numbers because these are the first data points that we've seen. And it's such a low number. I mean, we have not had such a low miss to the downside in inflation in years. So people are giving it a healthy dose of skepticism. So I'm just going to say, you know what? That's okay, because we got time until the end of January, until the next Fed meeting. And we'll get some more data on labor, on inflation, and then we'll compare these two and go, is this real? Like, is this, because I get it. Like, and I'm not even trying to get political or mindset or, are you bearish or are you, pro the administration or hate the administration, or you just, you climb a wall of worry like every bull market does. And all that's okay, because data course corrects every thought that's out there. That's why we dig into this stuff. Because it matters, because we're talking to borrowers who want to know, should I wait till next year to buy? Should I wait till next year to refinance? Should I sign a 12-month lease because I don't think I'm going to be ready to buy? It's unaffordable. And so, these conversations happen in the tens of thousands every day by realtors and originators who are locking arms at the local level, trying to coach our consumers how to think going forward, how to manage their debt, how to manage their long-term family growth, wealth strategy. That's why all this stuff matters. And of course, it's fun. So there'll be a few more reports. And with these other reports coming out in January, because all the major data is out, right? Like the inflation and labor data, we're done for the year. Okay. Of course, the QCEW, which doesn't really move the markets, that comes out tomorrow. Existing home sales comes out tomorrow. All important stuff. But our labor and inflation data, big reports, don't come out till January. And we'll have time to go, okay, now how did that one look? Is there distortion in the data because of the government shutdown? Month to month, back to back, how do they look? Is it still tracking, or is there some distortion? So now I don't believe it. So now we're going to sit back and wait for the March Fed meeting, right? Watch the 2-year Treasury. The bond market's pretty smart. It's below 350. They're sensing some weakness. People lose jobs, or it's hard to find a job. There's not enough money to spend and boost our economy. Therefore, gives you more and more clear guidance for the Fed to cut rates, which ultimately translates into, better mortgage interest rates. So that's that. And so, by the way, tomorrow we also get the Bank of Japan. It's actually in an hour or two, they will say whether they're going to raise their interest rate for their Bank of Japan 25 basis points. And why is that meaningful? Every time Japan raises the rates, this yen carry trade, it's actually blown up the stock market a few times. I'm not a financial advisor. I'm not responsible for your losses, only your profits. And I'm not saying that that's going to happen tomorrow, but it might. And tomorrow is also quad witching. You guys know what that is? So every third Friday of the month is triple witching, okay? And then at the end of each quarter is quad witching. So when you trade options or futures, which by the way, the futures market is way bigger than the stock market. So just a reminder, we've got index futures, index options, stock options, and single stock futures all expiring tomorrow. And there's like pretty much an 80% bet to the upside, calls, things are going to be better. Whenever these people were buying them, that they were going to be better as of business tomorrow. And if you notice, the stock market has not exactly been doing that great the last several weeks, certainly not since October 20th. But this week we've had one up day, really today, and then 3 bad days. But if there's an unwind with this Bank of Japan trade, this yen carry trade, some people are over leveraged. They got to sell a bunch of assets that bring some selling pressure down. All these options and futures and future indexes and all this stuff, they all, expire worthless. People are going to lose a lot of money tomorrow. And by the way, every day, $3 trillion gets traded on the Fed repo facility. That's people literally doing overnight borrowing to buy the issuance from Treasury to fund our government, which is why the Fed at their last meeting said, hey, we're gonna buy back about $40 billion a month in treasuries and bills, like short-term bills, kind of keep this thing going, just to have ample reserves because they're doing $3 trillion on their Fed repo facility every day. There's a tremendous amount of money floating around, and tomorrow's a pinch point. It's a really big deal. And so I think after tomorrow, that's one reason why I think maybe the bond market hasn't really rallied. Weak jobs report, weak inflation report, rates should be better. Why do we not get down closer to 4% on the 10-year Treasury? We've been in this 420 Elon line to perfect GPA, 4% line. We've been in that range for a while. Why do we not pierce lower? Well, one, maybe some people are kind of skeptical of the data and they're going to wait till next year. And we have these big events that I just described. And oh, by the way, we might have a government shutdown next month. So, some of this healthcare, 1 year, possibly 3-year extension of the Affordable Care Act, also known as Obamacare, that could be floating through to help people get some certainty about their insurance costs, which right now are rising. It's going like crazy. And when inflation goes down, we're like, yay, we're only at 2.6%. That just means it's going up a little slower. It's still going up, and people are still hurting, especially if they're not getting jobs. And so, there's so many part-time jobs that are bagged into these numbers. That's not as good as a full-time job. Worker productivity is up, and yes, weekly wages are up. So there's a lot of competing factors as we wind down the year. And so it's a midterm election year, which is historically choppy in the stock market. And there's a potential government shutdown. But we've got a lot of tax breaks coming into effect in the first quarter from the One Big Beautiful Bill. So there's a lot of forces at play. It's very turbulent as we wind down the year. So let's look to all that stuff. I don't know if there's anything else that I didn't touch on that's worth mentioning. I will say the Bank of England cut, and the European Central Bank did not cut. And so this is kind of a final thought here. The European Central Bank has been cutting, so they're kind of ahead of everyone. All these banks kind of work in motion, which is why when Bank of Japan, potentially if they raise before the end of my video, when you wake up in the morning, it's kind of counterintuitive to this trade that's been going on, this yen carry trade. So we'll see if it blows up anything tomorrow. Or if this is just an orderly Friday with no dislocation in the market where no one feels like anything has to be done. Banks are reserved very well. The Fed is reserving well. So we'll see if it doesn't really matter. So on that, one final point on the European stock market. Americans innovate, Europeans regulate, and China duplicates, aka steals all of our intellectual property. So I saw a very cool note from Les Parker at the TMS Spotlight talking about Europe, and they finally are admitting this over there, that they are basically saying that their regulatory system is too heavy, too complex, and too slow for the world we face. They can't get their stuff together, and they can't innovate. Low growth itself is their biggest financial and economic problem. That's why they've been cutting rates over there. And so it's a cautionary tale for us as an innovative country when we talk about regulating, and especially when AI is all the talk and all the rage as we roll into next year. So just something to think about. Tuck that in the back of your head. Thanks for sticking with me. Have a good one. Have a great weekend. Don't forget, I think you got about one more day left to bid on the PRMG Cares artwork. So if you stuck with me this long, go ahead and hit it up. Have a good one. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.